Hello, everybody. My name's Bob Plefsis. I want to welcome you to our All-Star Financial Q1 2019 webinar entitled Markets Bounce Back, but where do they go from here? A little bit before we get to that, Bob's Corner, I like to focus on a few things. Explanation of the yield curve, very simply. The Fed Open Market Committee, when the economy is doing really well, raises interest rates to slow the economy. That brings us to a potential recession type of time period where people look at an alternative to equities would be bonds. The demand for longer term bonds exists, and we have an inverted yield curve. Bonds are the smartest animal in the money side of the world. So listen and learn. They predicted the recession in 81, 91, 2001, and 2 years prior to the 2008 crash. So again, fairly smart. Real quick market overview. Markets bounce back. Where do they go from here? We had this big V-shaped recovery, worst returns since 1929 in December, best since 1987 in January. And there's really three factors that going forward we're going to be focused on, and that's what do corporate earnings do to this big bounce and volatility? Are interest rates going to truly stay flat? And will the Fed not raise them anymore this year? And will the tariffs and the concerns that we have with Brexit go away on the global side of the world? The U.S. economy, what can you say other than 117 months of expansion? What I can say is that during that expansion, it really hasn't grown all that much, only GDP of about a 20% growth. Typically, in an expansion bull market standpoint, it would be more in that 40 to 50% range. So the Fed really has a mandate to control inflation and control unemployment, and I think they've done a really nice job. They raised interest rates on December 4th, which scared everybody. We baked into a recession all the way to the 24th. They reacted after the market closed on the 24th and basically with a goal of stemming the downside. And they basically did that by saying there won't be any more increases in interest rates in 2019. So going forward, what is the likelihood of a recession in the next 12 months? 25%, and the probability even gets higher over the next 24 months. The yield curve, as we've talked about, that yield curve, what have the bond market's done during this time period? High yields were the best performer at 7.4% for Q1. The Barclays aggregate return was 2.9 for the quarter, 4.5 for the year, the last 12 months. And then Barclays Global was only about 2.2, but still very positive. When we look ahead on the bond market, the economy is really going to be the determinator. If it's going to expand, corporate high yields are going to be the best place to be. If we do expect a recession, longer term government bonds will be a place. Domestic stocks, the big bounce that we talked about, what kind of returns did we have? The Russell 3000 index was up over 14%, bigger returns on the growth side of that than the value at 16 to 12. Small caps outperformed large caps at 14.5 to 14. And we had some really good gains in the sectors, with tech gaining over 19%, industrial 17, and energy over 16.5. So when we look forward to the domestic stocks, we can say that literally our PE ratios have been yo-yoing up and down too, with PE ratios really extreme and overvalued at the end of 2017. 2018 by the end, because of Tax Reform Act and also because of that drop in December, they're very cheap. And then we had this big bounce back. So at 21x earnings, the market is actually fairly reasonably priced, maybe a little overpriced. We look at the international markets, the rebound across the globe wasn't quite as drastic in January because it wasn't quite as drastic on the downside in December. China obviously is our very volatile partner in the emerging markets, up 54% in 17, down 19, almost 19% in 18, and rebounding even almost all of that loss now here in 2019. Brexit and the vote there and the uncertainty there and the delay there has created, they're kind of right in the middle between the U.S. and the emerging side of the world at an 8 to 10% rate of return. And we feel really good about our average international exposure making over 10.5, almost 11%. When we look at the international markets, they are still the best buy in the world. PE ratios gives us a cost of doing business for every dollar's worth of earnings. All we have to pay in the emerging markets is $12. The developed markets in Europe are 13, and the U.S. again a little bit overvalued at 21.4. When we look at kind of a summary for the first quarter, you just remember that big V and the volatility that we had after our downturn in December, our best rate of return in January in many, many years. But remember the three factors. Are earnings going to stay on pace with what their expectations are? Is the Fed going to stay on pace as far as not raising interest rates as they promised? And will global growth continue to slow or maybe have some affirmation of growth based on settling of tariffs and the Brexit exit? So let's look at page 5. Page 5 has 4 charts. I'm not going to go through them with you, but these charts really tell some of the story that we've talked about most recently, all the way from what is an inverted yield curve to the Fed funds expectations, how interest rates really over the last 3 recessions have gone down, and our expectation then is that interest rates will stay fairly low. What revenue has done on graph 3, and then the inversion and dispersion, of returns from the domestic market to the international market on graph 4. Last but not least, page 6 of our newsletter. Want to focus on a little bit. We always go just for fun, a little restaurant information for you. We think St. Genevieve, a French-Italian cuisine, is very, very good. More importantly, on page 6, introduction of our new team member, Sam Sexton, CPA and CFP. Been in the business 9 years. Last worked with wealth management teams at Clifton Larson Allen, and really, really happy that he's come to our table and being a part of going to be a great part and an excellent part of our team. Quote of the quarter, I think this dovetails real well into our team and the commitment that our team has. Individual commitment to a group. This is Vince Lombardi. That is what really makes a team work, a company work, a society work, and a civilization work. So we really thank all of our teammates. We've got 14 great teammates right now, and look forward to many more as we grow. And last but not least, thank you for your continued trust in the All-Star team. Remember, our referral program can reduce your fee and obviously help us grow. So thank you for being a great teammate. We'll look forward to talking to you next quarter.